and anybody can just jump on as they come in. So I'm going to go ahead and get started. Hi, everybody. Good morning. My name is AJ Crawford. Just wanted to thank everybody for coming in today and learning about the ugliness of the insurance market. I just wanted to let you know I've been a member of NAPMW for over 35 years. All of the things that NAPMW have taught me have brought me to this stage in my life. It's offered me so many opportunities that I maybe never would have had without my involvement with NAPMW. So I just thought that would be important for you to hear that it's great to have you a part of our organization and you can make out of it what you want and grow your career just like a lot of us did. But we do come for the friendships. We stay for the education. And as your education chair nationally, I think it's really important that we stay on those pillars that we've founded our organization on. So we try to always bring you education, and it's great to see everybody taking part in it. I wanted to thank Angela Tyler. She is here today with Online Ed, and they are one of our strategic partnerships that we have going. She also, because of NAPMW, was able to offer me an opportunity to provide education for their company. And I now have two published classes with them, thanks to
Woohoo!
Angela.
You bet.
And if it wasn't for NAPMW, I don't know if these opportunities would have come across my desk. So I do appreciate Angela and Online Ed. They're great sponsors of everything we do. If you want any classes through Online Ed and you log in, at the end you'll have a QR code that you can scan, and it will take you right to their publications, and NAPMW members get a discount. So take advantage of that opportunity if you get it. I I can't see the participants because I'm looking at my notes, so forgive me. And I'm very clerically challenged still at giving Zoom presentations. I seem to do better in person, but I'm gonna muddle through this and see if I can leave you with some information that you didn't have before we started. So the one thing that people may or may not have experienced yet is homeowners insurance issues at closing or during a transaction. It's a real thing. It's happening a lot. And every time there's a natural disaster that occurs, snow event, flooding, tornado, fire, it affects everybody in that region, not just whoever's house or property was damaged. So you're going to start seeing a lot of changes with homeowners insurance and the things that we're going to have to do to assure that our client's going to get to closing and their homeowners insurance is going to be intact. I'm trying to change my screen. There you go. So what's driving today's market is really that simple. It's wildfire, it's natural disasters, rates can't keep up. State regulated fees and costs prohibit insurance companies from just raising their rate at any time. So they can't just raise their rate because they have a huge claim in a certain area. And so the regulators don't allow them to keep up with their risk. And I know you see it on the news, um, they all are making lots of money. They get these bonuses. And, unfortunately, we all feel like we're being scammed by insurance because it seems like they have lots of money that they collect from us for years and we never really, use it. And then when we need it, they nickel dime us. And I can tell you that happened to me personally. And it's not a good feeling when you pay for insurance all these years and you don't get to use it. But that is some of the reason why it's very regulated by the state authorities. So insurance companies that can't raise their rates or participate in a market where they can afford to make a profit, they pull out, such as California, Florida. Insurance companies are pulling out by the numbers, which leaves them with the FAIR plan. And if any of you live in those states, you might have heard the FAIR plan. It's not really fair, but it's an alternative to no insurance at all. And it's kind of a default option, and we'll get into that a little more in the presentation. Also, homes are becoming harder to insure just because insurance companies decide all of a sudden we're not going to insure a house that is made out of that or is over there. Manufactured homes are very expensive to insure, and different types of property, depending on the location, are really getting hard to insure. Insurance companies are charging astronomical rates or they're completely pulling out of the market. I know in the Northeast, they have storms going on right now. Here in the Pacific Northwest, we have an atmospheric rain going on. There's always something that's controlling the insurance market and changing our affordability to it. I'm going to go through some of these slides without reviewing because our class is limited and this is actually a little bit longer of a class. So I just kind of want to get to the meat of it, what you really want to know. If you have any questions, Angela's going to go ahead and keep an eye on the chat bar, and then we can review it as you go. Some of these topics fire people up, so we want to be sure and answer your questions when they come up. So these are the top 5 states that rank in homeowners insurance cost. And quite often I get, why isn't California at the top of that list? Well, it isn't that it's not at the top of the list, but how they calculate the cost for each state is kind of a little secret code, and sometimes they don't include all of the costs, such as the FAIR Plan. But these are the top 5 states. Florida, of course, you can guess why. Louisiana, Colorado, the U.S. on the average, you can see where we're paying. And then, of course, California and Hawaii. These are states with high risk factors. They historically have ongoing natural disasters, and so they tend to stay in the top 5. So what's the FAIR Plan? It's short for fair access to insurance requirements because, lenders require insurance. But it's basically a plan that was designed to help people, California and other states that have high insurance costs or no availability. They have insurance deserts where there is no insurance. These are programs to assure that people have protection against fire. It does not give them protection against many other things, but there are other policies that you can combine with them in order to protect the home against all the disasters that are going to incur. The FAIR Plan is not run by your government. It's not a state-sponsored entity. It's actually a group of insurers that are licensed to insure in your state, and they all contribute to this plan, and they share in the risk, the loss, the profit, if there is any. And it's designed in order to make sure that everybody has access to insurance. Most of these departments are run by a state-regulated insurance department. So if you had a complaint, that's where you would go, but they aren't actually a government-sponsored entity. Everybody's like, oh, it's a government. I, for years, thought it was a government-sponsored entity and realized it was not. All the insurance companies own it. So they offer you basic fire coverage with the FAIR Plan against lightning and smoke, homes and condos, rental properties, any kind of investment property. You can get the FAIR Plan on, but you have to show that you've tried with other opportunities, other insurance companies, and you weren't able to get insurance through them. They denied you coverage, and so your only alternative is to go to the FAIR Plan. When you get the FAIR Plan, you have to get another policy from an insurance provider in the area that will give you the difference in coverage. And that covers just about everything else that you could put into a bucket that doesn't get covered under the FAIR Plan. And so every time they add an exclusion, you want flood, that's a different policy. You want earthquake insurance, that's a different policy, and on and on. But say you have expensive items in your home, or you're worried about theft, those kind of things, that's where the difference in insurance coverage is going to come into play. It really is a last resort, the FAIR Plan. You really don't want to use it as an alternative. It's become the default plan because so many states are in insurance deserts right now. And I don't know if any of you, I wish I could see the chat, if any of you have had insurance issues in your state like California and Florida, you'll see your customers have to go through a lot of struggle to get insurance or to afford it. So it's not necessarily the best plan, but it's better than lender covered insurance because we know how expensive that can be. It's really a safety net. So it doesn't cover, the FAIR plan is not going to cover any kind of liability. It's not going to cover water damage. It's not going to cover theft or windstorm. And it's not for everything else. It's strictly only for fire, and it is a high premium. It's not affordable at all. It's very expensive. The other thing that the FAIR plan is notorious for is only offering actual cash value when it comes to replacing anything that's been damaged. So, for example, if your roof, say, was 10 or 15 years old, they may come back and say, well, the roof was old, and so we're only going to give you a portion of the value, what it costs to replace that roof, and you are going to have to pick up the rest. And so we want to warn people to look for that clause in their insurance, and you need replacement value, especially if you have a mortgage. The lender is going to require that you have full coverage and full replacement value. Although I have heard Fannie and Freddie are starting to lean towards allowing it. I'm not an authority on it, so I can't say, but there has been scuttle about it because insurance is becoming such an issue. I don't know what they're really, you know, going with that, but I know that they've been a little more lenient. So think that kind of gives you an idea. So the other thing is that they're two separate policies. These are separate policies that are written by separate entities, sometimes the same carrier, sometimes different carriers. It's similar to your flood insurance is a separate policy than your earthquake. Your difference in coverage policy is going to be a separate bill. It's going to be a separate expense. And so the claims, of course, go to separate carriers if there is a claim. I don't know why it changed on its own. Sorry. So you always want to confirm what the difference in coverage insurer is going to provide, and make sure that your customers know that they need to really read the fine print. This is really important at this point that we read the fine print. So why does it matter? It matters because your approval is subject to insurance coverage. We're starting to see that this is something we need to ask for in the first 3 days with the client going to contract. Let's find out what the cost is going to be, if the insurance is even available. It's going to affect your timeline if you wait until the file has been underwritten and the appraisal is done. In the past, that's how we were always did it. We'd wait until everything was done and we'd order the insurance binder. And within a couple of days, our documents would go out and we go to closing. And that is not the case anymore. Now you see the insurance companies are kicking back. They're asking questions. They want to know about the length of the roof. They want to know about claims on the property. They want to make sure that it's not in a wildfire zone. So these are the things that the underwriter is going to be looking at when a customer applies for insurance. They want to know the roof age and type. These are going to be red flags if nobody has the information. I hear a lot of scuttlebutt on Masters in Real Estate about, is it the seller's responsibility, the buyer's responsibility to know the age of the roof? And did we have an inspection? The inspector told us that the roof was fine, and then we moved in, happened to me, and the roof leaked. All of these things are important now in the transaction, and these are things that sellers and buyers should be asking because the insurance company is going to ask. There's also a thing called the clue report, and it's about your past claims. It goes over the history of the claims that were made against the property in the last 5 years. And even though the buyer didn't have anything to do with those claims, it's going to affect the insurability in the future on that property. It's also going to affect the cost. And I have some examples of what those clue reports look like coming up. They're also looking at homeowner credit worthiness. The homeowner might not have good credit, or they might have some credit issues. That in some states is an issue for insurance companies, and they can use your credit score to charge you more. Not all states allow it, but it is a factor. If they're going to run a business out of the premise, the underwriters are looking at that. What kind of business? How is that going to affect the insurability or the liability of the property? They're also asking about livestock. They want to know if there's cows and chickens, what kind of livestock is on the property. Is it a farm? Is it an agricultural farm? They're asking these questions now. In certain cities, you can't have more than 5 chickens. They want to know if you're meeting code. All of these things are coming into play that we didn't see before. And they're finding out because they're sending inspectors out to the property. So that's something else we'll talk about in a minute. But they know, and they want to know because it's going to affect their liability. They're also looking at the fire lines. They're looking at distance to fire service in Central Oregon. That's a real factor for insurance here. How close are you to fire services? How close are you to water in the event of wildfire? The first thing they do is they go online and they look at the pictures of the house that is trying to be insured. They look at the listing photos that may have been put up. Sometimes they find old photos that were there and maybe stuff has been improved to the property. And if we don't update those photos for them, they're going to make a decision based on what they've seen. They are now using drones to fly over the property because it's a lot cheaper and easier than trying to get on the property with barking dogs and whatever restrictions. I'm sorry, I don't know. I think there's an automatic timer and it's sending it on. Sorry. And then they do in-person inspections. They send somebody out to look at the property. They send a report back to the insurance company and they let them know, did you see a business? Are there, take pictures of the roof. Are there any issues we should know? Is there a trampoline? All of these things are being done in the underwriting process. And they have up to 60 days from the time the customer's applied. Even if you close the loan and are bound for insurance, they have 60 days to get out of it. They might find out something. They want to know, is it actually owner occupied? They knock on the door, they ask the tenant or whoever answers the door, are you the owner? These are all things that insurance companies are doing now when deciding if they're going to insure a property. My daughter was doing some of these inspections and it was amazing the things they wanted her to document. So these are the red flags that they're looking at in addition to, let's talk about the roof. Okay,
Okay.
let's talk about what they're looking at. If you see a roof that looks like anything like this and the insurance company sees it, they're not going to insure this property, or they're going to write actual replacement coverage or require it to be fixed before closing. We do see a problem with the granular loss or lifting shingles to be an immediate. They're not going to insure it unless it's replaced. Sometimes the moss can be mitigated and somebody can come out and treat it. But what we're recommending for real estate agents, and I teach a lot of real estate agents, let's get this mitigated before we put the pictures online so everybody can have a smooth closing. Because if the insurance company sees this, they're going to push back. Or very, very often, what will happen is they might not see it till after close, and then the customer gets the letter or the call and then they are finding out that we're not going to insure you or you have 20 days, 30 days to fix this after they've just closed on their home and, their funds might be low. So these are things they're looking at. These are things you can look at. Look at your appraisal when it comes back. Make sure all of these aren't an issue if you haven't checked prior. It's really important to start looking at these things early. You can go online and look at the property. I know most of you probably do. Trees and vegetation around the property, even though it's charming, insurers don't like it. They don't like anything touching the property. They want a defensible space around the property. Any of this they see after it's mitigated, they're going to require inspections to everything. I I'm almost certain if you look on the top of that roof, there's probably moss. We don't have a picture of it, but I would guess with everything going on with this property, there's probably some moss. They're looking at all of this. You see any of these kind of structures on the property, you're going to start getting pushback and they're going to want them taken down or repaired. Of course, no one's going to put the money into repairing this. Some people don't care if there's an old structure on their property, but for an insurance company, this is a liability and they don't want it. They want it mitigated, they want it gone, especially if any of these outbuildings have electricity going to them. That's going to be a big issue. So keep an eye out for this. You can educate your real estate agents that these are things insurance companies are going to start pushing back on. Also, if it has any kind of antiquated wiring on the property. And a lot of times they know this based on age or similar claims in the neighborhood because they have data and they share that data. And once they have it in their files, it's not going away. So any kind of antiquated electrical should be addressed. An electrician can go out and certify that it's in good repair, but the insurance company may come back after the fact and ask for it to be updated, and that could be a huge expense for a buyer that they aren't planning on down the road. So these are things that we're seeing called out on a lot. Also, the plumbing. Plumbing is a hard one
Olga,
because
Naja, Melina, Kayla.
it's a sorry. So, okay. So any kind of plumbing, it's really hard to see what's going on with plumbing, you guys. So if there's an obvious visual
Thank you.
that, okay, could somebody mute? Chris, could we mute him? Thanks.
Okay, done.
Thank you. Um, so any kind of plumbing that you guys run into that may look like it may be a problem. If it's older, galvanized, there's a crawl space or a basement and you're walking around and you see it, just take note that this could be called out by the insurance company. There was a time where PEX plumbing and this new polybutylene plumbing was installed in properties. We have some friends in the Vancouver area that had this. And what happened was that plumbing failed and it began to develop small little pinhole leaks and cracks in the plumbing behind the wall. And so it was months and years before it started to show itself. And when it did, it showed itself in the form of mold and then eventually complete failure and water damage. And it was a really big problem in some new homes that were built, high-end homes, I might add, and a lot of damage occurred. And so when insurance companies start getting these claims in the same neighborhood, in the same area, and all that data goes into the clue report, they start to realize there's a problem here. And then they start looking for these items in the future. So these are things they may or may not want to inspect, but we have seen it come up. And it's just good to remind everybody during the process that, especially if it's an older home, hey, the insurance company could ask for this. So let's talk about the claims. The claims. So I had a house that I bought, and the first day we moved in, the well went dry. And I thought it's okay. We have insurance for it. So I called my insurance and he said, no, we don't cover the well. And I had a warranty company and they said, no, we don't cover that. So insurance is a false sense of security sometimes because you think you can file a report and you can't. But guess what? They make a note of it. And they said, oh, well, we didn't pay a claim or she didn't, really have a claim with us, but something happened. And that's called a no claim, a zero claim report. So all of this information is gathered into what's called a clue report, and they pull this on every property before they insure it. And it has all the claims that are tied to the history for the last 5 to 7 years, including zero claims like I had. And it doesn't matter who owned the property at the time, the insurance company has access to this information, and it's used by insurers during the underwriting process. And a little tickle in my nose. Sorry. Thank you. Sorry for that. So anyway, the clue report is something insurance companies can pull up at their fingertips, and it's not something they share with the lenders or the real estate agents. It has to be asked for by the homeowner. The seller usually can get a copy of it. If the buyer had a claim on their prior property, that claim is going to follow them to the new property in the form of costs, not necessarily because of the property, but because the insurance company doesn't know, does this buyer use insurance as a form of maintenance? Are they making a lot of claims? And this could affect buyer insurability, even if there were no claims on the property they're buying. If they had claims on prior property, it may make them harder to insure. This is an example of what a clue report looks like. And it usually lists the property information, and it gives you a little bit. You can see here loss date, and the type. This was theft for burglary. And if you go through this, you don't see it was only a $500 loss, but this customer made a claim for $500. So I don't know that I would do that because you know what's going to happen. Your insurance is going to go up because you made a claim. I mean, we all know this, right? When we make claims on our insurance, it goes up inevitably. Even if you've been a customer for 20 years, they don't care. They're not loyal to you like you are to them. So this is an example of what a clue report would look like. And I have another one that shows a zero claim. I don't know if I have it in here, but I have another one that showed a zero claim and they dropped the customer at note can't policy canceled. So whatever the claim was, it was more than the insurance company wanted to take on for future liability. So it's always going to show water, non-weather related. It's going to show any kind of fire claim or wind. It's going to show if somebody sued you for, getting hurt on your property or any kind of property damage. Underwriters do pay extra attention, you guys, to water claims, especially if it's repeat. If somebody constantly has water claim damages, whether it's in a crawl space or a basement, laundry room, wherever that claim is coming, they're going to look really hard at it in the future. Oh, here's another one. So it just shows, it might be hard to read. I can't, mine's a little hard to read. But again, it shows that it was closed with zero paid out, and then the policy was canceled. So the best way to explain a clue report to your client, it's kind of like a credit report for the property. It shows all the claims. It's not an inspection report, but it can result in higher insurance premiums, exclusions. They may say, we'll cover this, but not that. They may not insure it at all. It may require the buyer to renegotiate the contract on the sale of the property because if there are certain things that came up in the clue report that they didn't know about prior, that could maybe cost them money down the road. I think they may want to renegotiate. And sometimes it can kill a transaction, unfortunately. It can actually, and it can delay the deal from closing because a lot of times lenders don't get the insurance binder until towards the end of the transaction. And so this comes up in the end. A lot of states like Washington and California are adding new clauses to the real estate contracts that address this very thing. And they're requiring buyers to get insurance within the first 3 to 5 days or get a quote and get information to show the premium and that the property is insurable. So it's not out at the end of the contract like it may have used to be in the past. So we don't want any surprises at closing. As a loan officer, we never even worried about it. My processor ordered it at the end. I never thought of insurance was not an issue. We'd write an estimate based on what most people. You're going to end up with surprise sticker shock to a buyer. All of a sudden, their insurance is double what they thought it would be. So these are some other things that I wanted to go over that are not included generally in a policy. Okay, these are not standard coverage things. These are things your buyer or you would have to ask your insurance company to give you extra coverage for. Of course, we know earthquake and flood is a separate policy, but if you have water systems on your property or you are in an area that's known to water accumulation, maybe in the spring, you have a sump pump or things like that. There are extra exclusions that need to be written to handle that. And quite often you want to couple that with a home warranty. Well, in septic, they don't cover it. And I don't believe they even offer exclusions for that. If they do, they're very expensive. And that would be something else you'd want to cover with your home warranty, like I had to. They also don't cover if they determine you have a claim and there was a slow leak or a hidden leak that had been going on for a while, and they went in there and inspected it to cover your claim and found out that it looks like this has been happening for a while. There are policy exclusions you can get in the beginning to cover that should that come up, but it's not automatic in your policy. If anybody is renting out a room, doing Airbnb, have a roommate situation, and anything were to occur, a claim come up with that, they may not cover that unless they know that you're doing some home sharing. So that is something when people are using roommates for qualifying income and things like that, let's make sure they have the right insurance coverage. If you're renting a home or a business, say out of the garage or a detached structure on the property, maybe, your husband had my partner has a mechanics business or maybe a lawnmower business, there's solvents and tools around that could create a liability. They're not going to automatically cover if you have a claim if you don't have those separate policies for that. Certain dog breeds, insurance companies may deny you coverage for certain dog breeds. We've heard about this. So some of them will give you a separate policy coverage for animals and livestock, but not all of them will. And that's something that the homeowner has to make sure they are disclosing to the insurance company. Again, if you have jewelry, guns, expensive artwork, you'll want separate riders and policies for that. And personal injury. If you have people coming and going a lot on your property, you have a lot of visitors, maybe you have a pool and you have friends over all the time, certain things like that, you may want to increase your liability because people are more likely to get injured. If you have kids, trampolines, those are things that your insurance company is going to want to know about. And it is not included in your standard policy that you were getting. Do we have any questions at this point? Anything? Anybody? Angela? No? Okay.
None have come in yet, but I'm
Okay.
monitoring.
All right. I'll keep going. So, real quick, I want to talk about an umbrella policy. What is an umbrella policy? For those of you that don't know, it is an excessive policy that covers everything under one umbrella. It's actually sold in $1 million increments. It's more affordable than you think. And what it does is it covers the gap between what your maximum coverage gives you for say medical expenses in your car. Say you only have $50,000 liability coverage for medical in your car and somebody were to get injured and want to sue you and take equity in your home or future paychecks, your umbrella policy can cover those gaps. And so we recommend an umbrella policy when anybody has more than $500,000 in assets. It is going to be an affordable extra coverage that will fill anything that you didn't have covered. And it also can help limit your liability in the event you are sued. Sometimes it's just the peace of mind knowing that you have it. A lot of times what we see are people are very underinsured on their automobile coverage. And so when they get in an accident, God forbid somebody gets hurt and they get the letter from the lawyer suing you, an umbrella policy can alleviate a lot of those differences between what you had coverage for and what you didn't. And sometimes the courts will limit the amount of damages that can be given in a lawsuit when there is an umbrella policy in place. Also, again, I want to emphasize that earthquake and flood insurance is not included in any policy, and you need to get those separately. I do want to point out that flood insurance, there are private insurers for flood insurance that are much more affordable than the FEMA plan, which I didn't know. I was in a flood zone on my property. In the first 3 years, we paid really high premiums because we were going through the federal plan. And then I found out there was a private insurer, and I was able to get a quote from them, and it was more than half of what I was paying in savings. I went from about $2,200 a year to $700, and it was a real substantial savings. And the problem with FEMA is they don't give you a refund if you were to cancel that policy in the middle and say, "Oh, I found a better policy." You're going to pay that premium for the whole year. They don't give you the money back. So anytime anybody's shopping for flood insurance, it has to be done on the anniversary of their insurance in order to, assure they're not paying double for the insurance policy. But I thought that was interesting to know. So here's a few takeaways that I think, are helpful to know. Insurance isn't automatic like it used to be. And where you're trying to get insured is going to be the issue more than anything. And then the price is going to be the second factor. Buyers need to shop it around. They need multiple quotes. They need to work with a broker, even if it's a local, hopefully somebody local that they can pick up the phone and call, not 1-800 we don't care insurance, because when you need that insurance to come into play, you don't want to deal with somebody that you can't get a hold of on the telephone. So they need to get multiple quotes. They sometimes might have to break their policy up. Sometimes bundling isn't the best thing. So make sure that you're advising your buyers to get multiple quotes. Get that insurance early. Make sure that you're communicating with the real estate agents about the condition of the property. Make sure that you have built a relationship with an insurance agent locally that you can refer business to, hopefully back and forth. But it will be good when you have a DTI issue and you need that policy to be adjusted just enough so that they can get in for qualifying. Having a relationship with an insurance agent can really make a difference. And set the expectation for your customers, especially in high fire areas or flood, such as Florida, the eastern coast. There's different expectations that are going to have to be met in order to insure those properties. It's a risk. It's not a gimme. Insurance companies, unfortunately, they really don't care. They're not loyal. And I was a loyal customer of my insurance company for years. And when I had claims, they were like, "Oh, sorry. Yeah, you aren't covered for this. You aren't covered for that." And then, of course, knowing that I had claims dropped me. And once you've been dropped by your insurance company, it's harder to get reinsured. So you get a letter that says you have 60 days to get a new policy. And if you don't get that insurance in time, then the lender has also gotten that letter and they're going to put lender forced insurance on your property, which is not going to be affordable. And one of the things I've seen most recently, especially with people on fixed income, their insurance has gone up to the point where they can't afford the property anymore. Even though they own the home free and clear, they can't afford the insurance. And so they're being forced to sell their properties or take on reverse mortgages in order to afford their properties. This is a QR code for online ed. There's a longer version of this class available on there. One is California specific, and one is a duplicate of this with a little more narration, a little more detail. Your discount code is NAPMW 30. And if you want a discount on any other classes, you plug that in and it'll automatically be applied. I wish I could answer some questions. I feel like I rushed through it, but I think we got the meat of everything. Does anybody have any questions that we could answer? Anybody? I can't see anybody. All I see are microphones and no cameras. So I
Hey,
hope,
AJ, it's
yes.
Ellie.
Hi,
Uh,
Ellie.
Hi. Do you foresee anything coming down the pike nationally for insurance companies? I know they can't do it statewide because they'll just pull out of the state like they did in California, but has anybody heard anything on the national level?
I have. There are several members in Congress that are trying to force states into certain insurance regulations. And those members of Congress are coming from states, Florida, California, Oklahoma, that have high insurance cost and insurance deserts. The problem is insurance is regulated by the state. And so it's hard to mandate states to do things from a federal level, unfortunately. But there is talk. It's affecting everybody. So there are things that they're trying to put in place, but as we all know, there's a lot going on in Washington, D.C., and I'm not sure we're on the priority where it comes to insurance, but there are people in Congress that are trying to put something together, and they're trying to create a better national plan as a fallback for people who are in insurance deserts. I don't know that we'll see it quickly, but I know it's being worked on. And California is kind of leading, California and Florida are leading that crusade because insurance in those states are unbelievable. And the average you saw on that chart it doesn't really reflect the true cost. My last client that I closed a loan for in San Jose area, south of San Jose in the Scotts Valley, They're a little bit in the, the rural area. Their insurance premium was $7,000 a month.
Woo,
A
woo.
month, you guys, 7,000 a month. And I have clients in Florida that are paying well into the thousands of dollars per month. So let's hope Congress can come up with a solution that will work with the states. And there's a lot of activity, but nothing being done quickly, unfortunately.
Yeah. Thank you.
Thanks for the question, Ellie. Anybody else? Has anybody had does anybody have a story that maybe you could share that has affected you and your transaction with insurance?
I
Any?
have one that didn't affect my client. It affected me. My insurance was through the son of one of my best friends who I thought would take care of me. And of course, my roof was getting older and older. In Oklahoma, we have so many hailstorms. You're thinking, come on, I need a hailstorm to get my roof replaced before it's too old. And it's a good thing it didn't happen, because after I changed insurance companies, they're the ones I had people come in and say, hey, let us just look at yours. And they told me that I would have been out 50% of the cost. I was
Right.
overcovered, and I had no clue, and my agent never let me know. And I was not a happy camper. So make sure that your borrowers know what they're signing up for.
Well, and that's where the actual replacement cost, little
Yes.
blurb in the fine print and
Yep.
not full coverage. And, when I had a couple files that my policies came in with that, and I was getting pushback from underwriting, they're like, insurance is not acceptable. And I'm like, what? Insurance isn't acceptable. And I had to go round and round. And then finally they were like, no, we won't. They finally told me, well, we don't accept actual replacement costs. And it wasn't obvious that that's what they were offering to the customer.
Right.
And can you imagine your customer closing on a property and finding out the insurance company won't insure it because the roof has to be replaced and they only have actual replacement cost? And so they're shelling out, our roof was over $40,000 to replace on our property that was leaking after we bought it, and they refused to cover it. So it's real. Especially, insurance companies are sending inspectors out. They're knocking on the door. They're taking pictures. And this is happening to a lot of people. I get calls from people that they've gotten the letter, and what do we do? And we advise people to really start paying attention to what's going on with your insurance,
Yeah.
and start educating the buyers. Share this information with your real estate agents. They're the ones that can really help make a difference, you guys. Insurance, it seems like, oh, it doesn't matter. I'm going to stay in my own lane. That's what I heard. I teach a lot of real estate classes, and they're like, oh, I'm going to stay in my lane. This is not my thing. It is your thing. You're going to have to start, they want receipts. Insurance companies are asking consumers for the receipts for past repairs. Now, what if your seller is long gone and he doesn't have your new buyer doesn't have any of the information? This should be part of our negotiations now when we're purchasing a property. You get that clue report. If there were any kind of claims in the past 5 years, you want to ask the seller, hey, can I have a copy of all of the receipts to prove that the work was done? Because now that I own the house, the insurance company could come out and ask for an inspection, and they may want to go in and make sure whatever damage was done was repaired so that they're not accepting liability from a past claim. And we see that a lot. We see it a lot. And we are seeing a lot of 60-day post-bind letters going out. Hey, we don't like this. We don't like that. We're not going to insure this property. So even though they thought they had insurance on the property and me as the lender thought they were insured, they're not. And they're getting the letter and they've got to scramble. And of course, they're going to call us. They're going to call the realtor and say, why didn't you tell me? And that's not the kind of referral we want. We want happy customers. So it is a real problem. Each state is specific to what's going on, but I encourage everybody to take this on earlier. Make sure you're having discussions with the real estate agents, the listing agents. A great reason to call the listing agent and talk to them while you're discussing the transaction. You can say, hey, I'm aware that maybe, we should look, was there a clue report? Is there anything we need to know about this property? And insurance, real estate agents a lot of them are taking these classes, so they're starting to be aware as well. And they know that this is going to be an issue moving forward. So you can be ahead of the game. If any of you would like this class for your real estate agents, we're happy to put it on. We can do it via Zoom. I promise I'm not that technically challenged, but I have a couple versions that are, 30 minutes and an hour. In Oregon, we are CE approved. So I'm happy to share this class with anybody that would, like to offer it. And I hope it was a little bit of information that makes you a little bit more aware of what they're doing when they're looking to insure the properties. So if anybody doesn't have anything, I really appreciate everybody coming on. I hope to see you all we have our National Education and Convention Conference the first weekend in May up here in Vancouver, Washington, right outside of Portland, y'all. So if you're so inclined, go on our national website and check out our conference because we have a great lineup of speakers this year. It's really affordable. And we would love to see you come and participate. So with that being said, goodbye, everybody.
Thank you.
Thank you. Thanks,
Thank
Angela,
you.
for all your support. We appreciate